let's talk about the difference between interest rate and the payment rate on your mortgage. You want to talk a little bit about that?
Yeah, that's something that's popping up in advertising now. People are being able to get away with saying 1% or 1.99% because instead of writing interest there, they're writing payment rate. Well, to the novice, you see 1% and you think that's the interest rate.
Right.
But the difference is your interest rate will still be a market rate, but your payment will be calculated as if the interest rate was that 1%. So your payment may not be enough to cover all the interest, but it's going to make your house more affordable. You may qualify for more house or think you qualify for more house. It's tricky, so the point is, know when you see 1% that there's more to the story and make sure someone explains the whole thing to you.
Is that what we call a negative amortization loan?
Exactly. You can call it negative amortization or deferred interest.
Meaning the principal will increase because you're not paying enough of the interest.
If you choose to do that.
Right.
A more common name really for us would be an option arm because there's so many options the way you can pay that mortgage off. So when we talk about a mortgage review,
all those factors.
The third stop in the mortgage review is looking at the mechanics of the mortgage. So if you've got a product like that that may adjust, the interest rate may adjust monthly or yearly, the payment may adjust yearly, but the interest rate adjusts monthly. So if you ask the average person, tell me about the mortgage on your house, your interest rate, is it going to adjust? They don't know. But when they came in initially, it was decided this was the best thing for them and for their financial goals and the plans for their family. This was the best product. Well, 12 months from now,
things change.
Is it still the best?
Yeah,
so that's the third stop of the review, and that's when you have to look at these special mortgages.
What type of buyer or what type of borrower would want to have that flexibility? Can you profile that person?
Yes, definitely. It should be someone that's an astute borrower and investor, and they're trying to achieve maximum cash flow.
And maybe some income flexibility that's not necessarily monthly. They have investments, they have some capital gains, and so they know where that's coming from and they can plan accordingly.
And they can take advantage of any of the options. They are a little bit liquid, so if they wanted to make a fully amortized payment, they could go ahead and do it. So that's the person that really understands it. I'll tell you who it's not for.
That'd be good.
Okay.
It's not for someone who can't afford the $3,000 payment, sees that this product is only $1,500 a month, half as much a mortgage payment. So they say, well, I'll take this and
figure it out.
And get hit with a brick,
you
know, 12 months down the line, and especially 5 years down the line.
Yeah, those aren't good.
They're not good, and a lot of those, well, a lot of those don't require you to qualify either. So it's someone who's just taking advantage of the low payment, and they really don't qualify for that mortgage.
So you can't just look at the short term; you have to look at the whole environment, the long and the short term, and how you're going to be able to handle it.
Well, you better, or the long term may be a nightmare.
Yeah.